We are going to start today's session with a conversation with Steve Mitzenmacher, SVP of Corporate Development at Rackspace. Steve, welcome to the show.
Great, thank you. It's a pleasure to be invited. Congratulations on all the accomplishments so far. And it's exciting to have the opportunity to speak with you today and be in front of the amazing audience you're able to assemble.
Thank you. Well, let's start by introducing our audience to you a little bit. Talk a bit about your background in Corp Dev. You've been at it for a long time, so Corp Dev
don't remind me.
Is your
Yeah,
deal.
I'm celebrating over 20 years of experience in corporate development across the enterprise software, enterprise hardware, and consumer internet sectors. I've worked at companies like Business Objects. We had been a leader in the business intelligence space that was acquired by SAP. I worked at Yahoo, and I just wrapped up almost 10 years at the hardware company that went through an amazing transformation to also becoming a cloud company, NetApp. And then recently transitioned over to join Rackspace Technology, which is such a unique company. They were really, the public cloud before the public cloud existed. They've gone through their own transformation, having gone private and recently going public again, and now a leader in hybrid multi-cloud solution offerings. But as a result, I've really gotten to see the gamut from enterprise to consumer, hardware, software, internet and cloud, and gotten to work with countless entrepreneurs and startups. I've worked on, well over 60 M&A transactions and corporate venture investments, and, I don't get enough of it during my day job. So on the side, also do advisory work to startups and, other accelerators.
So, Steve, I want to connect two dots here. One is you probably are very aware that we were also working with NetApp at one point with the NetApp Accelerator, and DataStax, this company that we have just announced a partnership with, was incubated inside Rackspace. Did you know that?
I do, actually, and it's a funny story because I've seen the original documents, and one of the first little projects I had to do in the fun days of, the parts of corporate development that are very unsexy are things like every month or every quarter dealing with the mark-to-market requirements of, any investments that we make. And it was after DataStax announced their latest funding round that we realized no one had done that work for about 10 years. And so we had to dig through the old documents and, what the company DataStax, was before it was named DataStax. So yeah, I'm actually very familiar with that history. And, I've seen the original funding documents to prove it.
Great. Well, I want to focus today's session on kind of helping our entrepreneur audience understand exit strategy better. But the reason I wanted to invite you to enlighten us is to provide a buy-side perspective on acquisitions. So tell me first, how do you think about buy-side M&A?
Yeah, absolutely. We're a unique function in organizations. And, when people, ask me, well, how do you spend your days? Especially, working at a company like NetApp, where, we're perhaps not as serial an acquirer as some of our peer group, doing a deal a week or a deal a month, where the cadence is a little bit, more ad hoc. And so it's a unique function inside of an organization, in that really we're sort of the special forces group. And I divide, a day in the life around kind of our time management into, the vast majority of it really on a day-to-day basis is what I call ecosystem engagement, where, we spend the majority of our time, deeply engaged with activities in scouting. We maintain the corporate, what I would call architecture or landscape map around the areas of focus and interest for us. We track the technology and investment trends, and are really at the forefront of investor and advisor and entrepreneur outreach for the company. So that's really our primary mission in supporting the strategy management work that we do. And actual transaction execution can be a very small part. I kind of ballpark it as sort of the sub 20% of day-to-day for us over the course of our overall time is spent actually driving individual deals. But deals are a real force multiplier for the organization, and they bring three distinct, in my view, potential ways to augment a company's strategy. And having done this for 30 years, you get forced to kind of come up with shortcuts and little catchphrases for what you do. And so from a philosophy perspective, I'd say there are three kind of deal archetypes that I represent as why an organization might do a deal. So the first C is what I call capacity, and that's your classic tech tuck-in or acqui-hire deal. And really, when you think about strategy, I'm a big subscriber in sort of the concept of the core, that some consulting firms use. And so in that example, capacity deals are about enhancing your core, and they're a way to fulfill kind of quick and dirty gaps in product offerings or go-to-market coverage. And you look for a set of characteristics that mean this is 100% sellable and additive to everything that's already kind of a work in place for your organization. It's same customer, same buying center, same selling motion, same business model, and it's a drop and go. So that's a capacity deal. The next kind of step function up in deal type is what I call a capability deal. And that's really about not just your existing core and enhancing it. It's about adding a new Lego brick to your core. And that might be your kind of bolt-on acquisition. But in that case, it's usually augmenting a new product or service offering that can add technology or features or go-to-market motion to your existing stack as an adjacency, but highly complementary to your existing portfolio. And so it's an extension, but it's not a radically new departure from what you do. And you expect it to be a similar selling motion, but perhaps a new value proposition or targeting some new use cases or capabilities. The final deal, and these are really more the few and far between, are what I call a catalyst deal. And that's catalyst with a C, not catalyst with a Q, though those of us in the corp dev world think about because of the mark they've made, Catalyst, those other guys. And the catalyst for me, those are really the transformational opportunities. And, that's where you're actually, going totally outside your core, expanding beyond your core. Those are typically going to be, your largest mergers or MOEs. And it's a new meaningful line of business expansion that, again, these are kind of fewer and far between when they come along. But these are the deals that certainly get a lot of press. So those to me are the ways that you approach a deal. And I think what's really important about that is usually that ends up defining who will be the internal lead and sponsor of the deal, because corp dev, we're really never meant to be the lead or sponsor of a deal. We're an internal service provider to the lines of business. But really, it's kind of at that step function of a capacity deal is going to typically be owned by an R&D or go-to-market line of business owner. A capability deal will be led by an exec sponsor at the R&D or go-to-market level. A business owner might be when you're thinking about who you're targeting as a seller. the senior director of product management or a VP of product management. A capability deal, look, you're probably targeting a general manager or maybe, the head of global go-to-market or head of global products in an organization. And finally, a catalyst deal, look, those are going to be led by the CEO and the board. So, that kind of helps you think about who your internal advocate's going to be, depending on the type of deal that you judge yourself to be for an organization. And then for the buyer, it's really important to understand what are your drivers. And I've found that a common factor in deal failure is you'll kind of misclassify a deal to get it done. You'll oversell or undersell a target because you're trying to fit that model to kind of hit the approval thresholds you're looking to get or the buy-in that you're looking to get for a deal. And you misset expectations because you've misclassified.
Interesting. So excellent framework for the discussion today. Now, this market map that you're talking about, the marketecture map, does CorpDev's view of the marketecture map and product view of the marketecture map match up? Are you sharing the same map, or are we talking about different maps in different parts of the organization?
Yeah, absolutely. I mean, that's a great question. And yeah, the goal definitely is that they should match up. And just like I like to say, a deal model, should never be CorpDev's view versus corporate finance's view on a deal model. The same is true of the market map. It should never be, a different model than, the product's view. And the same would be true when you think about, how you evaluate your customer map and your customer pyramid. Those are going to be shared. And it's, where there's that lines of collaboration around strategy that we hope to drive. So yeah, absolutely. That's a shared deliverable that, depending on how the product management is structured in an organization where ultimate ownership lies, may differ a bit, but that's absolutely meant to be a shared deliverable built-in partnership and something that really the whole organization can anchor around because it's such a fundamental piece of guidance around driving your strategic mission. It should help you understand what are the market segments that define our core.
So as a follow-up to that, the next logical question is, when you engage with the ecosystem around that marketecture, who is going and talking to the startups out there, which is our universe of entrepreneurs who want to engage with the larger players in their ecosystem in case there needs to be partnerships, there needs to be acquisitions, etc. Who are the interfaces? Is it the product organization? Is it CorpDev? How much, what is your guidance to entrepreneurs in terms of navigating the ecosystem from their point of view, working with the buy side of the acquisition map?
Yeah, so that's, definitely an area that, when I'm building my corporate development team and leading my corporate development team, I want to be the tip of the spear to drive that dialogue, my team to drive that dialogue, and then help those entrepreneurs navigate our organization. Now, sometimes, the matchmaking of how they find us or how we find them, can be, can come in a lot of different forms. And so we might not always be the first point of contact because, other ways of introduction get initiated. But we certainly want to be in the dialogue. And, we are, very focused on trying to, be the center of knowledge management on all those interactions. So, one of the things I pride myself on in the corporate development function is maintaining, our internal database of content management with that ecosystem. And, at a place like NetApp over 10 years, it meant building our own, proprietary Salesforce instance that was just, the corp dev scouting database with a couple thousand companies and, thousands of meetings and conversations and PowerPoint slides, catalog that you have for reference. So we definitely want to be the central point of navigation.
Very good. So if we want to send you deals to look at, you are a perfectly good point to make that introduction into.
Yeah, absolutely. I mean, the good news and bad news is that our mandate is to be knowledgeable enough that we can be a quick filter, and that I'm a big believer in the construct that quick no's are better than long maybes. So especially when it's a very clear, this isn't a space that's of interest for us, or to be able to not waste entrepreneurs' time, because the most valuable resource that they all have beyond money and access to talent is their own time. Also as the ability to help you intelligently navigate the organization in terms of where your opportunities should be targeted, who are the right product managers to evaluate and opine on if there's a fit or area to work together. We can help you find those individuals most quickly.
And I know you've recently switched to Rackspace. Have you created this marketecture map already for Rackspace? Do you have a sense of what is going to be your strategy of what you want to look for?
It was the first major deliverable that I committed in the role, because it's such an important piece of the conversation and really kind of our roadmap for how I think about where I want to prioritize my time, is knowing which one of those market spaces we need to be focused on.
And what are some of the highlights of that, whatever you feel comfortable sharing as directives or directional guidance, not directives, directional guidance to our ecosystem on what are the things that Rackspace is looking for?
Sure. So, we, pride ourselves on being kind of unique in the ecosystem relative to the competitors that we face day in and day out for our services, which cover, providing architecture, design, and build and deploy and maintain for, the gamut of private cloud, public cloud, and managed services. And so, there are a couple of vectors on the map that are important to us. Really a hallmark acquisition for the company that was done before I joined, but, we continue to be a part of the integration of, was a company called Onica, which is a leader in AWS, cloud services, advisory and managed services. That's given us a phenomenal footprint, the leading footprint in the AWS ecosystem. We have, capabilities in Azure and Google, but we aspire to, match our level of expertise in those public clouds as we do in AWS. So, more work to do to augment our set of capabilities on those platforms. And then, we also see the opportunity to continue to expand in some of the areas of new development and growth with, some of the more, kind of next generation sets of services that are taking advantage of the public cloud. So things like AI, ML, IoT, cloud native development, those are our services and capabilities that, we have existing offerings, but still, more to do to augment there. So those would be some examples of the spaces where we have the keenest interest.
And architecturally, it seems like you have one of the big public cloud providers like the AWS, Azure, or Google at the very bottom, and then you have tools and technologies to manage all that data that Rackspace provides and then you have things coming on top of that. Is that the right way to summarize your architectural framework?
I'm hiring, so if it sounds like you can help us with, and that's very much, kind of how we think about these stacks. Is kind of I call them like Lego block diagrams and how these get stacked together. So that's absolutely right. There's public cloud as the foundational layer. There's aspects of, the kind of the centralized management plane layer. That for us, we have a lot of in-house technology that we call the Rackspace fabric to manage. And then there's these next-gen services that run on top of that, AI, ML, IoT, cloud-native development.
So you're probably familiar with my writings on platform as a service, the whole PaaS movement. And
yes.
My thesis is that a lot of the SaaS space, the leaders in the SaaS space, or the most promising players in the SaaS space are going to evolve to become platform as a service players and get into that kind of stacked model where they will play in one layer and have people extending and expanding their capabilities in the next layer, whichever layer they're playing in. So it sounds like that's kind of what you're doing.
Exactly.
So switching gears a bit, let's talk about valuation. What role does valuation play in whether an acquisition happens or not? And I would like to focus actually on your first two categories, the very small tuck-in stuff, and then the capability extension one, the big acquisitions that are completely uncharted territory acquisitions. We deal with early stage companies, so that doesn't happen until much later in the game. So that's not as relevant for my audience at the moment.
Sure. Yeah, I mean, valuation is obviously, for good or for bad, where the rubber meets the road. And, what I hate to hear, and, I haven't heard it often in my career, but there are a few times that I do, and it makes me shudder, is, when those sponsor levels that I talked about, depending on the deal type, like the line of business owner or, the executive sponsor, say something like, I don't know if I have a walkaway price. That is, a very uncomfortable position to have to navigate against in my role as intermediary with, the CEO and CFO or others, because I'm always uncomfortable going into a negotiation without, clear boundaries on valuation. So it's an area that we do, a lot of work, and it's a lot of the, the partnership exercise between how you size the opportunity, that in working with the product and go-to-market representatives on the deal help you shape, what you commit to the leadership team, at the C level over what this deal will deliver into your organization, and then, what you set as an acceptable range of what you're willing to pay, and at what point the price, the return is not sufficient to warrant proceeding. And, in that regard, we'll go into any negotiation with a target with a very clear set of guideposts. We'll do sort of the football field where we'll say, based on all the work that we've done and, our view of the opportunity and what their view of their opportunity should be standalone. And, here's sort of the football field map of, where we can go in, and they should at least feel like we're giving them a respectable, market appropriate, because obviously, a big part of my job responsibility is to get the best deal I can for the company that I work for. That can meet the needs to, complete the deal. But, have to do it in a way that we do want the entrepreneurs who have, put in the blood, sweat, and tears in their organizations and put in that hard work and taken the risk to feel like, they get the appropriate reward. And we never want people to, bottom line, my goal isn't for people to feel like they got screwed to get the deal done. So
Yeah.
yeah, absolutely. Valuation is a critical player. I think, there's always going to be a bid ask, and, whether the math actually works out that 80% of all deals or something, close at the midpoint of each side starting offer, or however else it ends up shaking out. That's absolutely, deals, get kind of won or lost on if there's a meeting of the minds on what the value is.
What range would you put on your first two categories, the tuck-in acquisitions? What would be the valuation range?
Yeah, I mean, it's an interesting question, and
capability?
it's so subjective that having spent time in, I used to live in a time where an enterprise startup, or I'm sorry, an enterprise software company could expect 2.5 to 3 times revenue to be an appropriate multiple, and then you get into the world of SaaS where it's 30 to infinity times revenue is an appropriate multiple. And similarly now, being in the world of professional services, which is a big part of the Rackspace line of business, you used to live in a world where 1 to 1.5 times revenue for professional services was an appropriate revenue, and now you see, sexy cloud company consultancies, selling for 4 to 6 times revenue. So things are all over the map. But what I would say is, kind of at any given point in time, a capacity deal when it's just about the people. I kind of think of that as like a 1 to 3x revenue-ish multiple is usually kind of the range, and I say that at a very kind of high level. And then a capability deal, again, depending on the market, could be like a 3 to 10x, depending on if it's a SaaS recurring business or anything else. 10 times revenue is sort of a typical, what they say, SaaS multiple. That being said, these are all very, market specific kind of full force multipliers that you apply. So it's hard to be, too generic. Again, I think back to, what became the trend of acqui-hire, and people started talking about, $1 million a head being the right, range for an acqui-hire, when Yahoo was doing their, acqui-hire a week under Marissa Mayer. So, these things constantly evolve and change and subject to the market. And so, giving broad guidance is difficult there.
Well, in acqui-hire, it's really the higher price points would correlate with scarcity. If you have something very specific and very deeply sought after by the acquirer, that is where you get anything beyond reasonable. So, all right. Well, I would like to, if you can take us through a thought process around bootstrapping to exit. I have a thesis that, and I've had lots of conversations on this topic, and these days, actually, there's a class of venture capitalists who have also figured this out and are positioning themselves for this kind of situation. I'm a big believer in bootstrapping to exit. Startups with an interesting strategic product that achieves product market fit with no funding or with small amounts of capital infusion can have very successful outcomes for all stakeholders. What are your thoughts about such acquisitions? And this is, I would say, this is probably the majority of your capacity and capability acquisitions. Is that not true? And have you done such acquisitions? And could you share some, maybe a case study in capacity and a case study in capability, and kind of talk about the capital infusion versus the exit price? Just give us a little bit of a sense.
Sure. I mean, I think, look, obviously, aspirationally, the more bootstrapping that you can do, the more equity as a founder you're able to hold on to for yourself, the better your outcome will be. I think, the concern becomes, capital, is sort of, key to an organization's ability to expand, and you never, want to limit your ability to grow in a market and capture market because of capital constraints. And so, how you balance, being penny wise and pound foolish because of capital constraints. So look, I think that's why founders' jobs are so challenging and difficult is weighing those balance points. And it's one thing to optimize capital structure when you're the CFO of a big public company and having to think about debt and equity and do I float a convertible note as a CFO so I can do a little bit more share buybacks as a public company, and being the founder entrepreneur saying, well, if I took this much seed money and I could grow this much faster and increase my multiple because I'm now growing 150% instead of 20% because I just don't have the go-to-market capacity or R&D capacity to build and sell as fast as I'd like. So I think that my view on capability deals is no, those typically are the deals that are seeing legitimate Series A, Series B, capability deals. You're buying a real business with a real scale go-to-market, and you're doing tens of millions of revenue, and you're probably going to have required some forms of traditional venture to achieve that level of scale. And so I think the bootstrapping journey, if you have it really gets set kind of around aspirations, and just kind of the hit rates on all these are very hard when you think about the statistics of founded companies to funded companies to exited companies. It's still large numbers that get filtered down at each one of those levels. But yeah, I've certainly seen the examples of amazing cases of founders that go very far, bootstrapping, and are very conservative with how they raise money, so that by the time they're facing their exit, they're looking at still owning 30, 40 or more percent of cap tables, and seeing great outcomes as a result.
I know you have to run, so I'll just add to what you said by expanding the thought process to not just the ownership, but also the issue of what is the valuation at which somebody is willing to acquire. If you raise too much capital and price yourself out of the market, then deals don't happen. If you have arrived at $5 million in revenue with $20 million capital infusion, then the investor's expectations for a deal to happen is going to be a much higher price point, valuation point, than what an acquirer might be willing to pay. So it depends also on, what stage are you looking to exit?
No, I think that's exactly right. And, that's where good advice, around around the table for the founders is really important to kind of think through. We don't just think about control around the cap table from a financial perspective, but there are also questions of, how much of your vote gets diluted and how much governance control you have around making those decisions, because that's another important, fact to consider, is how much control you have as the founder, so that, it's not your investors that are telling you what the price is that is the acceptable price, but you still have enough influence so that, both, economic, as well as kind of the governance drivers are still maintained in a way that you get the outcome you'd like to have based on all the work that you've put into your enterprise.
Steve, I should let you go. I know you have something else. Thank you for coming, and we'll continue the conversation later.
Yeah, great discussion. I hope that was helpful.
Very helpful.
Again,
thank you.
I'll close by saying, I don't get enough of this stuff with my day job. I keep a good, robust portfolio of companies that I help as an advisor. And, I have a very easy email, mitz@rackspace.com, also available on LinkedIn. So thank you again for the invitation, and best of luck to, all your entrepreneurs.
We'll be in touch. Thank you. Folks, I'm going to spend a few more minutes just closing out some of the thought trains that Steve shared here, just so that you understand this topic a bit more. So we will start with the entrepreneur pitches in just a moment. Let me just take a few more minutes to explain a few more points here. So this notion of valuation versus how much funding you raise is a very important point to keep track of. So we heard about two types of early stage deals that Steve discussed, the capacity deals and the capability deals. So in the very, very early stage deals where companies are acquiring to bring capacity in, the exit prices are remarkably lower, right? 1 to 3x of revenue. So if you've done 5 million in revenue, which actually is not that common, and you're getting 5 million to 15 million in exit price, you have to control how much money you have raised to make money off that deal. So if you have bootstrapped the company, then a 5 million to 15 million exit on a 5 million revenue deal is great. Everybody makes money. If you have a small amount of capital infusion, maybe 1 or 2 million, $3 million of capital infusion, and you get that exit, even that, I mean, you haven't spent like 10 years doing that. You're doing this in a compressed time frame. That also works out. But if you raise 20 million to get to 5 million in revenue, and then you sell that for $5 million, nobody makes money. That is considered a failure. So this is why I want to introduce you to this notion of bootstrapping to exit for the smaller deal size category. Now, if you get to Series A, Series B, where you are, on a trajectory to raise, $10, $15 million of capital, $20 million of capital, and you want to get to, $20, $30 million of revenue and get like 5 to 10x on the valuation, that's a different kind of deal. That is not a bootstrapping to exit deal. That happens. It happens plenty in the industry because right now the number of acquirers acquiring are much larger than it used to be. So the market has more liquidity. But pay attention to what your capacity is to get to that kind of revenue level. We had recently a very, very good discussion with Warren Weiss. If you haven't listened to this discussion, please do, where we talk about security deals, for example. There's a lot of entrepreneurship in cybersecurity. But if you look at the customer side of, enterprise customer side of cybersecurity, the CISOs, Chief Information Security Officers, or the CIOs, are so swamped with new technologies and innovation, it's very difficult for them to evaluate a, seed stage product. So for a seed stage product to get a seat at the table and being evaluated by a CISO, for instance, is going to be hard. Same kind of situation happening in DevOps. There's a lot of stuff going on, a lot of innovation going on, a lot of little point product innovation going on, which would work better if it sat inside the feature set of another larger player within the segment, whether it's cybersecurity or DevOps or whatever. So this is a category. These are situations where you need to position yourself for an early exit, and you have to do your venture in a capital efficient, time efficient way. So this conversation will be continued. I will have other guests talking about this issue because this is becoming a very important issue for the ecosystem. So I hope you found today's conversation interesting and useful, and you will learn a lot more on exit strategy and how to formulate your early stage funding strategy in relation to what exit is viable.